Hello, and welcome to our 2020 Agribusiness Roundtable webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I will turn it over to Brian Powell, partner and Agribusiness National Practice Leader at Brian.
Thanks, Amy. Hi, everybody. Thanks for attending our 2020 Agribusiness Roundtable webcast. I remember the good old days when we used to meet in person. Wish we could do that now. As I said, my name is Brian Powell. I'm a partner at Moss Adams in the tax area, but also the National Practice Leader for Agribusiness. And Moss Adams is a fully integrated professional service firm dedicated to personally assisting clients in growing and manage middle market companies. We're approximately 3,200 staff and 25 locations, and mostly on the West Coast, but serve clients throughout the United States and some outside of the United States. Our agribusiness team is focused entirely on the supply chain of agribusiness and all of its unique attributes from the grower to the consumer and all of the points in between. We really enjoy that space, and our food, beverage, and agribusiness group is about 1,400 clients currently, so we're pretty sizable within our Moss Adams footprint. The first speaker today will be in 2 parts. We'll have a panel presentation on the second part, and we'll have the landscape of agriculture presentation by Curt Covington on the first part. Curt joined AgAmerica team in March 2020 and began his career in 1979. I appreciate that date a lot, Curt, so thank you. As a senior director at institutional lending at AgAmerica Lending, Curt's major initiatives include building customizable products as well as developing efficiencies for large loan process as companies continue to evolve. Prior to AgAmerica, Curt was an executive vice president and chief credit officer for Farmland Partners, and he is also the owner-operator of the Agricultural Lending Institute headquarters in Fresno, California. Throughout his career, Curt has held various positions in agricultural organization and has spoken as a keynote speaker in various ag conferences. He is also a professor at Cal State, Fresno agricultural economics for more than 25 years. So, Curt, I'll turn it over to you.
Thanks, Brian. Well, this is a new world. I've done a few of these presentations virtually, and I can tell you that it's always a challenge, and I appreciate Moss Adams putting this together, and I hope you'll find what I'm about to present interesting and thoughtful. I would also say that to cover kind of the agricultural landscape in 30 minutes, I could be here until, sorry for the pun, but I could be here until the cows come home. I thought I would pick, given that it's mostly or has a high degree of Western audience, to cover some of the more particular crops out west, but also some of the mainstay crops like corn and soybeans. So let's kind of get started. So I kind of graded out the agricultural economy. And again, this presentation is pre-chaos, November 4th, 2020. So what I'm presenting here, and anything related to any policies of the U.S. government, was based on what I knew in October. The landscape there has, I would say at the very least, has changed a little bit, and so there may be some differences going down the road than what I originally expected. So overall, how would I grade the agricultural economy? I probably would give it a C+, and you'd say, well, okay, well, what sectors are you covering, and why is that? So I start out with corn and soybeans and wheat. Generally speaking, I consider it to be a C, but trending, an uptrending or improving market. The almond sector, this would probably be one of the first times I guess I would downgrade that sector. It's probably a B or a B minus, and the trends probably are trending down. The pistachio market, BB plus, with a steady and stable trend. The citrus market, which is kind of interesting, is probably a B and trending up. Fresh fruit and vegetables, B plus, with somewhat flat to maybe slightly improving trends. The wine industry, I don't even know what to say about that. There's a number of things going on there that have since happened since all the fires in California that lead me to believe it's probably a B minus industry, but you could probably convince me that maybe it might be trending upward a bit. The dairy sector, what can I say about the dairy sector? If I'd been talking about this 9-10 months ago, I probably would have graded it not a B, but a D for dog. But since then, we've seen some improvements in that market. And then I would just say there's probably a grab bag of a bunch of other commodities that simply we don't have enough time to talk about: beef, pork, poultry, hay, cotton. But we'll try and just make some very quick snippets around that as well. So let's just talk about the grain sector. You know, if you look at the upper section of this slide, the soybean market, we're now above what I would consider break-even pricing. In fact, some of the highest pricing for that commodity since 2018. Most of that's on increased export demand from China and projected lower ending stocks. At the time when I put this together, I said, you know, our biggest headwinds here are probably our China trade relations, given that we now will have a new administration, or we believe we'll have a new administration in place. My thoughts around that could, and others, could possibly change. As it relates to corn, again, also above break-even pricing based on a smaller harvest, expected shorter supply. And I think the headwinds in that area generally are in terms of lower usage, particularly for ethanol. What I would say here, and I address this to both our CPA friends, but our banking friends and also our farmers that might be on this call, is that a lot of people think, well, wow, with improved pricing in the corn and bean markets, we can expect improved liquidity on the balance sheet, improved working capital on the balance sheet. I think the challenge with that is many Midwest farmers over the last 5 to 6 years have just kind of been hanging on. And I think what we're going to see is with this improved pricing is that farmers are probably going to reinvest in their dirt, improve the fertility, because many farmers, over the last several years have probably ratcheted back on that. And I think the other thing that this liquidity is going to be used for is probably to make major repairs on equipment and improvements to equipment. So anybody, and particularly agricultural lenders out there that think that this is going to be and solve liquidity problems, I'm not so sure that's going to be the case for everyone, because there's just been, as I would describe, deferred maintenance of land and deferred maintenance of equipment where this capital is going to go to. Let's talk about almonds for a second. B minus. I think these two charts pretty much tell you all you need to know. If you look at the chart on the left-hand side, the gold bar would represent bearing acreage of almonds. And as you can see, it's kind of been the hockey stick over the last years, and there continues to be continued increase in bearing acreage. You'll also see non-bearing acreage is a significant amount. It's roughly 200, as of 2019, probably 275 to 300,000 acres of non-bearing that will come into production. What you have to balance here is how much of the bearing acreage is going to go out in the next few years, replaced by new bearing acreage. We don't have figures for that for 2020 yet, but as anytime you approach, and if you look at the chart on the right-hand side, we approached or got nearly close to a 3 billion pound crop. And what I would say about the almond industry as a general rule of thumb is that they have done an excellent job, particularly the almond board and the major participants have done an excellent job of marketing their crop. The one thing about almonds is that it has a high degree of utility, meaning it can be used as a snack food, it can be used in commercial baking, it can be used in other commercial products, but it also has byproduct use, right? So the almond hulls can be used in the dairy feed sector, and of course, almond fluid, almond juice. My dairy friends won't allow me to say almond milk has also improved the offtake. But if you look at the blue line, it pretty much tells you everything. It has been a difficult year to market. We have seen some recent improvement in almond prices, but I think I think $1.75, $1.80 almonds is probably the new normal going forward. And the issue with that is there are many farmers out there that have a high amount of debt on their property, and $1.80 almonds is going to be difficult for those that carry a lot of leverage on their balance sheet to break even. Next, oops, go back. Pistachio industry, I think here's the problems with pistachios. I mean, first of all, it's an alternate bearing crop. Many of you know what that means. For those that don't, they've never been able to breed out, although they're trying to breed out the alternate bearing features of pistachios. And if you look at the acreage on the right, again, you see a slight increase in the amount of bearing acreage. It takes 7 to 8 years to get them to that point. But if you look on the right-hand side and you see the annual production and the pounds per acre, that chart, it's pretty much all over the board. So the most difficult thing for the American Pistachio Commission is to be able to know exactly what their carryout inventory is and how they're going to market the crop globally. Where estimated market prices are for 2020, I think it's probably fair to say that the average pistachio grower is going to break even for sure and make a little bit of money. Citrus has been interesting. So the chart to the right-hand side, I could have pulled a number of different charts, but I would have you look at the fresh market Valencias and the green line at the top. The green line represents where market prices have been over the last 46 weeks in the Valencia marketing. And if you compare it to 2016 prices of Valencias versus 2020 and in between, Valencias 20 years ago were thought to be a variety of citrus that was going to go by the wayside. It still is a good export commodity, but you say, what has happened in the last several weeks such that Valencia prices and frankly all other fresh citrus commodity prices have done so well? The answer is enter COVID-19. Consumer perception that fresh oranges must be a good antidote. It would be fair to say if you talk to the packing houses across Central California, Southern California, even Texas and in Florida, they've seen year-over-year price increases on villagers in this example of 77%. Lemon prices have been up 10 to 20%. And honestly, the only thing that kept lemon prices down was the Chick-fil-A roller coaster, because the fresh market citrus or the fresh market lemon crop, much of that was, at least through Sunkist, was destined for Chick-fil-A, and then COVID-19 hit. Many of the Chick-fil-A stores either closed or slowed down. That has since changed, and now the market for lemons has improved significantly. Fresh fruit and veg. So I think this is probably on the upswing. I grew up in California and farmed. My family farmed stone fruit, almonds, walnuts, wine grapes, even cotton, believe it or not, in California. But the stone fruit industry has had significant consolidation over the last 20 years. There's probably 6 major players in the market today on the West Coast, and there's a few on the East Coast as well. What's happened is that it's a market that produces probably double what the market can absorb at good prices. This year has been different because of the coronavirus food assistance program through the USDA. The coronavirus food assistance program, if you're not really familiar with it, it might do you good to see what it is. But effectively, it was working with citrus, vegetable, and dairy producers and processors across the U.S. to provide kind of a lunchbox program. And that lunchbox program was what I would view as the term, I guess, would be very lucrative. It was a lucrative market for the stone fruit business. And those major players that were able to participate in that program had and are still having a very, very good year. Again, long-term viability of that, do I see another round of this COVID-19? No, I think that program is coming to an end. So there's going to be more balance needed in the supply and demand for me to keep the fruit sector, particularly the stone fruit sector, at a B+. Historically, I would look at the stone fruit industry as probably a C at best. Washington apples. Washington apples still has a lot of Red Delicious, Gala's, Fuji's, Granny Smith varieties that continue to have margin compression in the marketplace, averaging around $12 to $30 for a 40-pound carton. The Honey Crisp variety, for any of you who've had a Honey Crisp, you know that it's the latest and greatest thing. And anything in the stone fruit and apple business is always a challenge. And it's a challenge because the breeders are always out there breeding newer, better varieties. The grocery stores are demanding them. And unfortunately, the producers are having to replant, graft, and add these newer varieties. So it's a cost burden for both the stone fruit and the Washington apple industry. But, if you had Honeycrisp as an example, it outperforms all the other varieties and is averaging about $50 to $70 a box. The wine sector, this is kind of a wild card for me. The wine sector was in a position of significant oversupply for all the major varietals, Cabs, Chardonnays, Merlots, on down the list. Then the Northern California wildfires have hit. And so there's a number of issues that are happening here. And I've heard this anecdotally. I can't speak to this, but we've heard anecdotally that much of that wine grape crop was smoke tainted. And I'll say smoky Cabernets are always really, high priced. This is a different kind of an issue. Anecdotally, we've heard that loads are being rejected at wineries. Operating losses in that sector haven't been determined, but if history is any indication, the losses are going to be in the hundreds of millions of dollars. The 2020 crop year in California was facing oversupply until the fires. And so if you look at the chart on the right, which is the California bulk wine inventory, January through October, you can see a steady decline in inventory. So the current events have resulted in depleted inventories of the 2019 bulk wines. So it's been driving up prices. So this B minus could easily, at least from the perspective of pricing, potentially trend to a B plus at some point. But in terms of the economic impact on the wine industry, the fires have been devastating. And I'll cover a few other things with regard to the supply chain in that matter in a few minutes. Dairy sector. I've lent to the dairy sector for 43 of my 43-year history, and I would just tell you that the dairy sector struggles because there really is no, how would I describe this? It's tough to find ingenious ways to do different things with milk, right? I mean, it is either for beverage use, right? Milk purposes, whole milk, low-fat milk, or it's for cheese offtake. And I would just simply say this: the total consumption of milk products in all forms grows only about 2% a year, which would be about the rate of growth in the U.S. economy. So it's not like we aren't in a very mature market. It is an incredibly mature market, and there's been a significant amount of consolidation both in the dairy sector and on the processing side. So let me just kind of give you an example of what I mean by that. If you were to assume that production of milk cows remains the same year after year, and that's not the case. So the number of milk cows in the U.S. continues to grow. It's about 9.3 million producing cows in the U.S. If you add 186,000 cows to this 9.3 million, you actually well, this actually happened in 2008. We increased our cow numbers by about 200 to 250 cows, 250,000 cows, and it caused a complete collapse in the milk price and went from $17 to $9.90, literally within about 4 months. So the challenge with the dairy sector, and continues to be a challenge while cheese consumption continues to grow, it is a very mature and what I would view somewhat of an inelastic market in that, an elastic market in that it doesn't take much. Literally, a 2% change in supply can tank milk prices. And where we are today, I give it a B because I think the average dairyman today is probably going to earn about $1 to $2 a hundredweight. Some of the best, most efficient producers could earn probably in 2020 up to $2, $2.50 a hundredweight. The milk futures heading into 2021 would suggest that $16.50 milk per hundredweight. The average producer might make 50 cents to $1 a hundredweight. Again, the dairy sector, if you look at CME class future prices and you see the gold line across the middle of that chart, that's kind of the break-even milk price. So what I anticipate for 2021 is that there are going to be a number of producers that don't make a lot of money. There's going to be obviously the exceptional producers that will. And all I would say is that how we respond to the COVID-19 going forward is really going to determine how milk prices perform. And also, it's also going to determine where the bottlenecks are. There's been a significant amount of bottlenecks in the delivery of milk and in the processing of milk and cheese throughout this COVID environment. So, Amy, I see we have a poll question. So should I turn this over to you?
Yes, thank you, Curt. So our first polling question is, how did you hear about this webcast? A, Moss Adams invitation, B, Moss Adams contact, C, LinkedIn, D, website, E, colleagues, F, other. And I'll give you a few minutes to respond. To participate, please click the button next to the answer you choose and hit submit. And as a reminder, if you would like to receive CPE credit for today's webcast, you must respond to at least 3 of the 4 polling questions. And I'll leave this up here for a couple more moments. Okay, back to you, Curt.
Thank you, Amy. So this whole thing about grab bag, this is my 15 seconds of fame. All I would say is there's so many sectors we could talk about, but I will tell you this. It looks like favorable production environments for both beef cattle, probably for hay and for hogs, and also improved pricing for those commodities. So from my perspective, and I think what most lenders would say, depending on what sector of the beef market you're in, whether you're financing the cow-calf operation or backgrounding operations or the feedlot operations, will determine how your producers are going to do. I think, in my view, the cow-calf operators are probably going to see some improvement in pricing, and I would say the same for hog operators as well. So the supply chain disruption or eruption, this could take some time, but I really just want to tell you that it's so fascinating to see this from a banker's perspective. Those that were visibly disrupted, for example, the wine sales industry, the wine business is focused on three things. Either you have a wine club, or you're doing the restaurant trade, or you're doing retail. You might be doing some or all of that, but I would just tell you that if your wine business was totally focused or significantly focused on the restaurant trade versus at-home consumption through a wine club or through retail locations, you really did get hurt. And the restaurant trade really hasn't improved much for the wine sales. Again, that's all going to be a function of how quickly many of these states allow for in-restaurant dining. The protein sector, whether that be hogs or livestock or even poultry, these plant closures that took place because of COVID-19 earlier in the year created huge shortages and backlogs. So some of the unintended consequences of this is that while there is plenty of hogs to go to market and beef cattle to go to market and poultry, the closures created a significant backlog, and you saw it in the grocery store. The farm to family, direct-to-consumer trends have helped some of these sectors. So I would simply say you see a lot of interest in smaller boutique farming operations that are beginning to realize that, maybe a direct-to-consumer approach isn't all that bad. And so you see many of them trying to build websites. You see many of them trying to reach out to consumers. And again, not on a large-scale basis, but we do see some farming operations, particularly in storable commodities. I mean, an almond sector would be a great example where you see a lot more direct-to-consumer trends that are taking place. This limited mobility and work-from-home orders drove higher retail food prices through most of the summer. Restaurant trade, Q3 saw some of the softening of what was the recovery. Most of that is because there was continues to be no new stimulus package. Continued higher unemployment and social distancing and the requirement for outside dining. Depending on where you were and where you lived this summer, outside dining was not where you wanted it to be. Lastly, I would just say the takeaways from some of this, though, I think consumers, and I actually had written this prior to the current issues that we see again in the COVID-19 breakout. I think consumers are better prepared to deal with another outbreak, and I think they're proving that today. Work from home could, and this was an interesting study. There was, and I can't remember who to give credit for. I was reading an article, but they simply said, work from home could double from 5 to 10% in the next 5 years, which would cause some significant structural changes in the supply chain management. Lastly, I just, I think we'll be able to get this done in my allotted time. I just think here are some things that I would just tell you from a lender's perspective. In the old days, and again, maybe when I say the old days, when I started in banking, we were really focused on farmers' ability to do their job vocationally. I mean, did they have good husbandry skills? Did they have good farm management skills? Rarely did we focus as much on the other three factors I've listed here as we do today. So farm and facilities is really important. So, the average production history of that ground, the quality of the dirt, the quality of the water, depending where you are, particularly out in California, and maintenance of facilities is really an important thing that we focus on. But I think the other three things here, management and succession planning, has become a bigger and bigger issue. I've heard this said, and I don't know which number is right, that the average age of the farmer today is 62 years old. I don't know if that's 58, 62, 72. I just know that the current generation is getting closer and closer to that retirement stage. And for lenders, particularly long-term lenders, the big question is, what is your succession plan? Is it somebody in the family? Have you groomed someone for that? If not, who in management will run this until potentially another management team comes in, or if the plan is to sell the assets? All fine and well, but the management and succession planning is becoming more and more important. I would also say that marketing is becoming more important. Questions we never asked 15 years ago about what's your marketing plan? Do you have a written marketing plan for your commodity? What does that plan look like? And do you follow that plan? You know, it's one thing to have a written plan. It's another thing to actually be following that plan. Here's what bankers will tell you, right? I lent you cash. I want to get paid back with cash. A lot of that simply comes down to how do you mitigate your price risk in the market? And so a marketing plan is being asked more and more of farmers today, regardless of the sector that you're in. Finally, I think financial acumen is important. You know, the challenge bankers always have is that no banker today wants to tell their existing customer that, hey, you know, tax returns and a self-prepared balance sheet isn't adequate anymore for the size and scope of your operation. You know, many banks have rules, and the rules say something like this. Well, if the operation is complex, has a lot of subsidiaries, has a lot of moving parts, you probably need to get better quality financials. You need to probably get reviewed quality financials. Or the size of the credit has grown. Maybe you brought this customer in when they were borrowing $1 million or less. Today they're at $10 or $15 million. Maybe there's some inventory or information risk in the business, right? Inventory is always a big issue in terms of how it's valued and you know, how it's accounted for. But if there's any type of information risk, it generally qualifies for better quality financial reporting. The challenge that bankers always have is they walk in and they present this credit still today with tax returns and self-prepared financials. And the argument always is the credit folks say, you know, we need to start getting better financial reports. And the relationship manager says, oh, well, if we do that, they'll just go to the bank down the street because they don't require it. You know, I think that's a cop-out. I just believe that in today's world, folks like Moss Adams provide an incredible value, not just to their customers, but I think they provide an incredible value to the bankers who, by the way, are our primary source of communication with our borrowers is through their financial reporting. So while all of them are important, I think financial acumen and having good financial reporting is becoming more and more important. And my last statement around this is that the regulators are beginning to require it as well. Last, my conclusion, it amazes me how resilient American farmers have been. They continue to be creative in how they deal with their finances in some really tough times. And I look back to the corn and bean sector. Many bankers were envisioning the farm crisis of the 80s. And you know, we haven't seen that. And the reason we haven't seen it is I think farmers have done a really good job of managing their costs. They have done a super job of managing their costs. The other thing is I think land values have remained fairly strong. And again, depending on where you are in the United States, land values there have been pockets where land values have declined, right? Lower quality ground, maybe in the Midwest where the average production history or the corn suitability rating for those properties might not be the best. You've seen some pockets, but the land continues to sell and continues to move. You go out west or in other parts of the Smile, right, from Washington, Oregon, California, Arizona, through Texas and into the Southeast, you know, you've seen land values climb. So that has been what I would say a real advantage. And I think lenders, as a general rule of thumb, are poised to finish the year pretty strong. When I talk to bankers, and I've talked to a lot of them over the last 6 to 9 months, most of them have said, we're actually a little more optimistic than we were in January. And here we are, and I've talked to a few bankers just in the last couple of days who have said, we think this year is going to turn out better than we had expected. So Amy, or Brian, I will turn this back over to you. And I just appreciate the time.
Yeah, I think great job there, Curt, and thanks for focusing on specialty crops. That was well done. I think we'll sneak in one question there that Ashley had is how has California adopted to the federal marketing order impacted dairy short term, and how do you see it going long term?
Yeah, so the milk market, so for those, California was always under a state marketing order for dairy. The big challenge was when this was voted on, well, is this going to help improve prices or is this going to cause problems? Ultimately, and I would say that joining the federal milk marketing order is probably going to improve pricing for the California dairymen. I think if you really look at it, what I would say under a microscope, it probably has improved pricing 30 to 40 cents a hundredweight for them. I think the bigger challenge is for many of these dairymen, and I don't think this has been solved yet, although I know it at some point has to be. Most of the dairymen in California have a pool quota, right? And it's always been on their financial statement, and it has significant value. What happens to that pool quota if with the adoption of the federal milk marketing order? Can they, there's talk about securitizing and selling them off. I mean, I just don't know what happens to that. What I would say is I think it's a general rule of thumb, the dairymen in California who are very sophisticated, very efficient, have benefited from being under the federal milk marketing order versus the state.
Thanks, Curt. I appreciate your talk and insights, and I think we'll go to the second phase of our session here on the roundtable panel, and that will be moderated by James Rothenberger. And James has been is a partner at Moss Adams, actually Moss Adams Capital, and his role in our firm is to actually help companies sell or acquire or raise capital or actually use alternative corporate financing methods for additional capital. His focus is also on food, beverage, and agribusiness and other industries like manufacturing. Prior to joining Moss Adams, James was an associate at a market private equity company based in the Pacific Northwest. James, turning it over to you.
Thank you so much, Brian. Can you hear me okay?
Yes.
Good. Thank you so much, everybody, and thank you to the panelists here who are sharing their experiences and insights investing in the agribusiness segment. I lead our firm's food and agribusiness M&A practice, just as Brian said, helping companies raise capital, sell their business, buy another business, and we're fortunate to have three folks here on this webcast today discussing a tremendous amount of experience that they have investing in this segment. And I'm going to let Matthew Corbett, Paul Pittman, and John Duryea introduce themselves. And I'll start with you, Matt. Please go ahead, and then we'll go to Paul and John. Matt, you may be on mute. Why don't we go to John? Do you want to introduce yourself and your firm here briefly?
Sure, I'll lead off, assuming you can hear me okay. I'm John Duryea from Blue Road Capital. We're a fund based in New York City, but focused on agribusiness really around the world, both on the production side and on the supply chain. We're big in the tree nut space and growing pecans in Georgia and Arizona. We have a big shelling facility where we own Diamond, California, the big walnut business, where all of our well, all of our pecans and walnuts go. We have a business in South America in the table grape sector, and we've got a big leafy green business in watercress, arugula, and other baby tender leaves, and really focus on the specialty area of ag where we can be ideally the biggest player in that individual sector and produce better, hire better people, and have a better part of the supply chain and be more valuable to the end market. So a range of different things. We've been doing it for a number of years, and appreciate being here. And thanks for Moss Adams, who helps us do all the above, both from a diligence point of view when we're looking at acquisitions, as well as from an accounting point of view for the businesses that we buy. So thanks for having us.
Thank you, John. Paul, do you want to introduce yourself and your firm?
Sure. This is Paul Pittman, and I'm the Chairman and Chief Executive Officer of Farmland Partners. We are a REIT traded on the New York Stock Exchange that owns a diversified portfolio all across the United States. We're in 16 different states, about 150,000 acres. That portfolio is about 70% traditional row crops, corn, soybeans, wheat, rice, etc., and about 30% specialty crops, the sort of things Curt talked about, usually in the Central Valley of California.
Thank you so much, Paul. And Matthew, do we have you back? We're going to move forward here and let Matthew introduce himself later on here, but appreciate you, John, Paul, and Matthew being here. So the topic here today that we're discussing is M&A and financing activity within agribusiness. And agribusiness, a traditionally very fragmented industry, is moving to the forefront of investment activity as consolidators and financial investors appreciate the long-term demand stability the sector offers. They appreciate the family and generational transitions that need to occur for baby boomer owners, as Curt addressed earlier. They believe that they can assist with the demanding capital requirements of the industry. They believe they can be value added when addressing scale issues, overcapacity, supply surety, quality and diversity of ingredients, and will really believe that the fragmentation of the industry is an opportunity that will offer investors enhanced returns when consolidation and scale is realized. So this is the topic we're discussing here, and I'm going to have work for a few different questions, poll questions. The first here, how do different investor types view opportunities in the agribusiness space? And John, maybe I'll start with you here. In light of a rapidly changing and consolidating agribusiness industry, what segments is your firm targeting, and have you found opportunities within these segments to deploy capital and invest in businesses?
Sure. I hope you can hear me. I've got a lot of background on my side, so hopefully you can hear me. But I would say, as a general matter, in the past maybe 5 years, probably 3 years in particular, the number of potential investments that are coming through a typical Wall Street investment banking process has increased dramatically. I mean, years ago, most of the things that we did came from relationships that we had with owners or family members or managers who we thought were great people to sort of partner with eventually, and things sort of came up on a relationship basis after years of sort of knowing each other and developing perspectives on each other. Now, I'd say you're right. In the past several years, both Wall Street M&A groups have sort of discovered agriculture and agribusiness as a place to go ply their trade and make money on. And it's obviously more the larger businesses. I mean, the bigger sort of agribusiness companies are large transactions that have big fees, so big banks are finding their way there. And there's been some interesting things there for us because, as a general matter, the larger the company, more than likely the larger player it is within its sector, which is one of our ways of being in the agribusiness space, is finding the bigger player, biggest player, or creating the biggest player. The most recent transaction we did in the leafy green space was an auction process. We typically never are involved in an auction process, but it was a company we've known for years and years. It had previously been sold in a direct deal to somebody else, but this was the first time the asset had sold in 50 years or something. So I'd say we are seeing more transactions on a marketed basis. I'd say they're typically bigger transactions. The exception to that is there is sort of a second, or really a third layer of banking companies that lends banking services to companies that are maybe smaller than $30 or $40 million, that are more venture-y and startup, and think greenhouses and indoor farming and that kind of thing, where they're more venture-like and smaller, but have a little bit more sex appeal associated with them. So in terms of volumes of transactions that we're seeing, it's a handful of really big deals and then a lot of really small deals where someone has decided to put a sort of technology venture capital wrapper around agriculture. And you can imagine our perspective on some of those.
Very interesting. Thank you, John. Matthew, do we have you back?
Yes, I hope so.
I can hear you great. Why don't you introduce yourself and then discuss some of the platforms that your firm is trying to build in the agribusiness space.
Yeah, absolutely, James, and good morning, everyone. And my apologies for the technical issues earlier. My name is Matthew Corbett. I'm a partner with Fiera Comox. We invest in agriculture principally in the U.S., Australia, and New Zealand. Currently, we have 3 agricultural partnerships in the U.S., 2 on the West Coast, and those are Allville Fruit, which is a Washington-based apple and cherry producer. And in California, we have an almond business as well. So we invest principally in the form of equity partnerships alongside of farmers. We very rarely do anything 100%. We think in agriculture, it's really important to be invested alongside of a top-tier farmer in any sector that you're investing in. So that's the manner, James, that we've gone out and invested over the last decade or so. We've invested about $3 billion in agriculture and timber as well, basically borrowing from the private equity space where equity partnerships are far more common. We think it's very important to have a very good alignment of interest with a top-tier farmer. And the partnership that probably everyone on the line would be most familiar with would be our partnership with Allville Fruit, as I said, a Washington-based apple and cherry producer, and essentially we're in a very long-term partnership with that management team. And the expectation is that we're going to grow that business substantially over the next few years through a number of different ways. And as an organization, we're relatively new within our fund structure, but we do have a perpetual fund structure, which we think is very important as well.
Thank you, Matthew. Really appreciate that. And Paul, I'll give you the option to maybe describe a little bit the platforms your firm is trying to build within the agribusiness segment, and what segments are you trying to target?
Well, we take a little bit of different view as a public company. Our investors tend to be institutional, would be 50 or 60% institutional owned, and the rest would be individuals. We have probably a little bit different perspective than I think some of the commentators had today. We think that row crop agriculture is the most important piece of U.S. agriculture. It certainly is by acres being farmed. It certainly is by total dollar output nationwide. It's a very misunderstood sector. We own quite a bit of specialty crop as well. It's not that we don't like specialty crop, it's that we also like row crop. And that is particularly in the grains, historically, sort of small family business sort of industry. We actually embrace that. We think it's a great thing. The wealth underneath that industry and where the investment comes from is really partially farmers, but probably equally, if not more important, is the investment from people with sort of rural roots, but don't really make their money from agriculture. Curt alluded to, in the prepared remarks in the first half, he alluded to the fact that corn prices, soybean prices, wheat prices, they've been really terrible until just about 2.5 or 3 months ago for about 5 years. And how did farmland in the Midwest hold up? And I would contend it held up because your local doctor, your local dentist, your local owner of the mortuary, so on and so forth, continued to be large agriculture investors. And even though farming wasn't very profitable, the rest of the economy in small town America, frankly, was. And that's a continued investment source into the industry, generally hard to tap into. I don't think we necessarily tap into it either. But it's really kind of a powerful supporting investor group that is almost always going to be there, and I think holds up prices.
Thank you so much, Paul. Appreciate all three of you. 3 unique strategies within the agribusiness segment. I'm going to go to a polling question now here. So hope folks can see this on their screen here. But we're going to have 3 consecutive polling questions following each of the next question segments with the panelists, and hope is to get some real-time feedback here for folks as well. Could a financial or institutional investor be helpful to your business? Select any that apply. Please go ahead, and we'll give folks a few moments here to respond, and then we'll show the results on the screen here. Still waiting for some responses to come in here. And again, you can select any that apply. Let's give folks just another about 5 more seconds here. Okay. So a good diversity of responses here, as we might have expected. Could a financial or institutional investor be helpful to your business? We have a number of different agribusinesses on the webcast here today. In general, a pretty even split between yes and no, I would say. Just as a summary takeaway, pretty even split between yes and no. John, I'm going to start with you, put you on the spot here. Any reaction to that? Perhaps a mixed response, yes and no, an institutional investor could be helpful to my business.
I would have expected a little bit more diplomacy from your Moss Adams invitees, but that's a different issue. I'm joking, obviously, but look, I'm not surprised. I would say that in general, when people think about institutional investors, they think New York City and Wall Street and distrusts and what do they know about me? And for the most part, a lot of that's deserved. I mean, we've seen a lot of different funds, and let's call them private equity funds, for lack of a better word, who have sort of who've seen some of the businesses we've looked at, and it doesn't go over very well. I mean, farmers in general, and I'm not sure of the complexion of everybody who's on your webcast here, but they're very private, proud people, and they know what they want to do and how they want to do it. And when there are things to buy, they'll buy it the way they want to buy it. They go to the ag credit system, and they understand and want to be stewards of their businesses. In many cases, are generational businesses where bringing someone in who's not a person but an institution changes that potential sort of legacy and culture. So I'd say that in general, institutional capital has an uphill battle in convincing certain components of the sort of family agribusiness market, farmland owners in general, that it can help. I mean, usually that's the case when transactions are bigger. And I think to Paul's point earlier, when things are sort of smaller or in town and you're buying your neighbor's asset, things can be kind of done within the family, within the system. And it's easier to do, and it's going to continue to be relationship driven. On the other hand, if there are bigger things to do and larger things to buy or things to do outside of a particular geography. Of course, one of the things we try to do a lot of is geographically diversify the crops we're growing for the obvious reasons, or if part of the strategy is being vertically integrated, so not just being a pecan farmer, but being a pecan sheller as well. And some of you on the phone may know that pecans are not a cooperative market. There's a lot of contentiousness between farmers and the handlers. My point is, if there's a vertical strategy that's beyond just the purview of the individual farmer's business, then it is institutional capital. So it sort of depends on what the reasoning is. If it's estate planning or if it's buying a neighbor, less so. But for larger transactions or for vertical integrated strategies, or for being able to recruit different caliber of people, it can be more helpful. But I'm not at all surprised. I would say that maybe 10 years ago, it probably would have been 20% yes and 80% no. But it's an uphill battle.
Thank you, John. Appreciate the color. Paul or Matt, anything else you noticed from the poll results here?
I don't really have anything to add.
Sure.
I think John said it well, James, that farmers probably broadly recognize that most investors simply are not structured to meet the timelines of their business. Many institutional investors are structured as 7-year or 10-year closed-end funds, which simply doesn't match the timeframes of most agricultural businesses, where you plant a tree, you have to wait 5 years for a crop. You want to undertake genetic improvement in your herd, that can often take 3 to 5 years. And if you have an investor at the other side of the table that is only able to invest for a 5 or 6 year period, it's a timing risk. Farmers are smart enough to know that that doesn't work. Generational capital is what has made agriculture successful for decades and decades, and most investors are not grounded in agricultural fundamentals. So good operators have a very valid reasons to be rightfully skeptical of institutional investment.
Thank you all. Appreciate that, and appreciate the audience members with the feedback there. So switching gears here a little bit, coronavirus and its impact on the general due diligence process. As many of us here know, the due diligence process to close these investments and transactions is quite rigorous in a normal environment. But perhaps COVID-19 has altered in some ways the ways that the three of you might approach due diligence. What are the areas in the due diligence process where you have been putting more emphasis? And Paul, I'll start with you.
Yeah, so I may have a slightly unpopular point of view here, but I think from a due diligence perspective, the COVID situation was overdone. We ended up with, for example, a major financing that got delayed about 3 or 4 months because one of the institutions we were working with had a no travel policy imposed on their people. That's not what's happened in rural America. I have a home in San Francisco, for example, and San Francisco Bay Area was essentially shut down. But if you hop in your car and drove to Central Valley, those people were still working. They were, still shaking hands, still, doing a little bit of social distancing, but just getting on with it. And we in our business sort of did the same thing. So it's interesting, this question kind of goes back to the question we just had about why there's some resistance from people in the ag industry to bringing institutional investors in. When I would tell one of our farmers in the Carolinas that if I would never have thought to tell them that one of our staff members wouldn't travel to see them. I personally have, flown probably 40 or 50 flights since last April. It's just not really slowed us down. When you think about what the industry is, thank goodness, this really is about food production, not just making money. And it's an industry that is essential in the true meaning of that word. And, thankfully, most of the participants in the industry just kept going. The small local rural banks have done a good job of keeping financing in place. larger institutions, I think, have stumbled a bit because, they have a more urban view, but that's not entirely true. I think the Farm Credit System, former MAC, was good about continuing to kind of stay open for business with some modifications to how they did things. But we at least haven't seen much of a problem, except where we bumped up into, sort of organizations that have one foot in the ag world and another foot in the urban financial world. Other than that, we didn't see much impact.
Yeah, Paul, I think that was well said. A very good, honest perspective. Appreciate those comments. And John and Matt, I want to ask for your response on this, but also ask a slightly more specific question for the two of you. COVID has impacted the demand side for different segments within agribusiness. It's also had some supply interruptions. How do your two firms view these perhaps one-time changes that have resulted in the COVID environment, either from demand bumps or demand degradation or supply interruptions? How does your firm view those holistically as you're valuing these investments?
Sure, it's John. I guess I can go first, Matt. Well, it really depends. I mean, just within our portfolio, we've got one business, the diamond nut business, where demand is through the roof in light of the whole COVID situation. I mean, people are literally, again, forgive the pun, squirreling away nuts these days. It's tremendous. We've had to put people on allocation, and Walmart's not getting what they want. It's a good problem to have, and demand is crazy. We have other businesses where if there's a food service component to the end market that's really suffered, the question is how do you shift your supply chain and your packaging and your logistics to service a different end market? I'd say on the larger side, if you're a very big player in the produce sector, it's easier to keep and get business. If you're more of a niche player and you try to go from food service to the retail market, it's a little bit harder because most procurement folks want to limit the number of suppliers. It's also been a pretty mixed bag, say, in produce. On the one hand, produce has, I think, as a general category, fresh produce has had a pretty good pop from the COVID era, but there have been exceptions to that. Some of the things that are on the wet rack in produce have suffered because they're out in the open and they're unpackaged, and table grapes in particular have suffered. And that's because if you think about going to the supermarket and going on the produce aisle, people tend to pick at the bags of grapes and produce, and you really want to buy a bag of grapes that someone's been touching that day. And grapes are also kind of a social communal thing you might eat at home and have out. So it really is very end market and commodity specific for what in the past several months, what's been benefiting or not. I think our view is that, we're obviously terrifically grateful that there's vaccines that are coming down the road, but is there going to be some element, I'm not sure how much, but some element of permanent change in more food done from home, more cooking done at home, a little bit less appeal to going outside in a closed environment next to your neighbor? Probably so. Is it going to dramatically change the landscape? No. But I think in the short term, we really are seeing when the country does shut down, people still probably eat the same amount of calories, but in a very different way and in very different places. And the food safety, right down to the way it's checked out of the store, really matters when people are concerned about getting sick.
Matt, before you turn in here, John, I just want to make sure I heard something. Your firm is expecting some level of long-term change in consumption habits.
Well, that's right. That's right. I think that there's been enough of a scar on people who either have had COVID, or families or friends who've had COVID, or they've seen what's happened, that I think that they're going to be, and maybe I'm a little bit influenced by our offices in New York City. We're not in New York City, but the offices in New York City, and Midtown Manhattan, which has this just terrific, traditionally this terrific bustling economy of lots of things, including restaurants. I'd say half the restaurants in Manhattan are never going to come back. They're just not. The demand's not going to come back. The rents are too high. I think in major metro areas, say democratically run states, it's going to be a lot different. I think in the heartland, it's going to be probably very limited effect. But overall, when you sort of blend the populations together, I think people are going to have long memories about this. Than if it's not, if COVID's done, then they're going to be concerned about, well, gee, what's the next thing? Do I really want to go out and risk my life? So, is it going to be completely back to normal? I don't see it. Is it going to be like it is today? No, but there'll be some residual knock-on effect for the food service sector, where I think it's changed for a long time.
Thank you, John. Matt, anything you would add in terms of your firm's diligence process and how you view potential one-time changes here as a result of COVID?
Yeah, I think John used the operative word there, that there are some fundamental shifts, perhaps not in the calories or the breakdown of those calories, but perhaps even the location of calorie consumption will probably shift. In the commodities that we're invested in, we've not seen material changes due to COVID. In many cases, we had significant optionality in markets prior to COVID, and that, I think, is important to the resiliency of the performance through COVID. Some commodities or businesses that have had limited market optionality prior to COVID, if their channels have been shut because of COVID, they've suffered badly. We weren't really exposed to any of that. And I think Curt used an operative word as well, as an essential service. So COVID really has highlighted the fact that agriculture is critical. We often hear about toll roads being a critical piece of infrastructure. They're not nearly as critical as food. So through this crisis, alongside of our partners, we've needed to be resilient. We've needed to keep working. We've been working from different locations, perhaps from time to time, but it hasn't shifted the essential nature of what we're doing, which is producing food. So our process really hasn't shifted a lot due to COVID, and our focus in due diligence hasn't really shifted a lot either. I think we will see some mild shifts in consumer patterns and traceability, healthy consumption. I think these were long-term trends anyways, and COVID perhaps will accelerate them a little bit.
Yeah, thank you, Matt, John, Paul. All very good comments through that session here. I'm going to go to another polling question, folks, and I want to make sure we leave time for questions as well. And so we've got two more polling questions, including this one. What areas in your business have potential diligence issues investors and buyers might find? You can select any that apply: financials, record keeping, management team, legal, litigation, contracts, environmental, other. None, you're clean as a whistle. We'll leave this open here for a few moments while we get a significant majority of the responses here. Give folks another probably 30 seconds here. And we've got a couple more questions here on valuations within agribusiness and structuring, how transactions get structured within agribusiness. We're going to, after this question, we'll address those topics. We'll give one question, we'll open it up to Q&A. So moving right along. Okay, just another 5 seconds or so for the last regulars. Okay, so pretty even spread here, which you might have expected. Good job. It's good. These diligence processes are quite robust. We have a number of folks
James, your audio is cutting out quite a bit.
John, any comments on this?
James, I actually could not hear the question. You cut out on me toward the end, so say it really fast. Your audio kind of degrades over 30 seconds, so if you can repeat very quickly the question, I apologize. I didn't hear it.
John, any comments or feedback on this?
I couldn't hear the question. I couldn't hear your question. The first what you were saying is your audio died out on me. Well, I didn't see it. I don't have on my screen the results, so I can't comment.
This is
I apologize.
Paul. I can respond to this if that's okay.
Please.
So when you look at this, you know, the kind of diligence challenges that we see when we acquire properties, it really sort of depends on whether we're buying into a business, which is what most of the specialty crops really are, because you've got the trees or the vines on top of the ground and a complicated irrigation structure. Even if we don't really invest in the direct business, you've still got elements of that business embedded with the land. So then it tends to be a lot of legal, financial, and environmental due diligence, as well as the agronomy due diligence related to, you know, what's the age of the various blocks and what's the varieties and all the rest. And then obviously the markets that those varieties go to. The diligence on the row crop side for us, you know, just tends to be purely a land-based analysis. So there may be some environmental depending on the situation. But frankly, most of it is just the title insurance and the typical ownership issues related to land. So the diligence process is pretty simple. So the comments didn't really surprise me at all.
Paul, can you hear me now?
I can hear you.
Great. Strange. Apologies for that, folks. Why don't we move here to the last section so we can leave a little bit of time for Q&A, and I want to get to the last polling question. John, why don't we start with you here? This is a large, complex industry, agribusiness. What factors support a higher valuation with the industry versus a lower valuation?
So, well, I think it's, you know, I'm not sure I want to make an industry comment. I would say, in general, well, there's some obvious points, right? The demand for food is everlasting. I think in a crazy world, that matters. That matters to lenders. That matters to people who own equity. That matters to any sort of institution. So, I mean, part of the reason why probably everybody on the panel here is interested in this space and fully supports it is because of all those factors. The demand for food is endless. And I think as a general matter, the increased focus we have on the supply chain and healthy food and being able to trace where our food has come from and then more healthy eating, it's also not just a staple, but it's going to make us healthier, live longer, and happier. So that's all those great things that you want in a business, you know, food happens to have. I'd also say that, you know, rates, one of the questions that came up earlier that on the slide was, is now the time to lock in rates and borrow now or not? I think the answer is yes. I mean, capital right now is available. So from a lending point of view, I'd say, and this is just a general commercial for our farm credit system and for Curt in general, if there is a borrowing, let's talk about the borrowing side and the equity side. I think for the foreseeable future, my advice for anybody would be stick with the people who understand agribusiness. There's a lot of lenders out there who have discovered agriculture as a space, but they don't understand the volatility of farming and things never work the way you think. And you can have a much, much more receptive audience toward how things develop and happen and things that are outside of your control that the traditional lenders will appreciate and give you plenty of flexibility on, which other new lenders who've discovered this space and perhaps are bidding valuations up just aren't going to understand. And the lenders you might have at the closing of a transaction might not be the same lenders in 2 years if something goes poorly. So I know it's a little bit of a convoluted answer, but when it comes to valuations, it's capital, both on who's going to lend to you. You got my advice there. On the equity side, there is more capital focused on the space. I mean, 10 years ago, we probably could not have had a roundtable like this. And there was a range of funds of capable people with lots of capital behind them who have support for the industry. So I think a combination of it's a great area with terrific people doing smart work to provide a better quality product, healthier, et cetera, with a willing lender base that's growing and a willing capital base that's growing. That's all what's behind valuations going up and probably deservedly going up.
Thank you, John. Matt, anything you would add there in terms of attributes of companies that warrant higher valuations versus lower valuations?
over the longer term, I think higher valuations will need to be supported by cash generation that's sustainable, and cash generation that is broadly not from mining an asset. It needs to be coming from a sustainable production of a high quality product into a consumer that values it more than a typical commodity. So higher valuations need to be supported by cash flow generation. What we've seen a lot of is investors that are distracted by historical capital gains supporting valuations that are not supported by cash flow generation. So a farming business needs to produce a good, high-quality product that the consumer values more than a commodity, and it needs to generate that cash flow sustainably without mining the asset. On that basis, they should be valued at very high multiples. Otherwise, again, this sort of historic reliance on capital gain, it can't continue indefinitely. Cap rates can't be compressed indefinitely. So cash flow generation in a sustainable way is really what is needed to underpin some higher valuations in the space.
Thank you. Paul, anything you would add there?
Yeah, I actually have something to add. I think there's a real misunderstanding of the productivity gains in this industry. I was a farmer for quite a while. I farmed about 13,000 acres of row crops and owned some feedlots for about a half a decade. And obviously I grew up in the business. But when you look at the productivity gains in any of the sectors, I mean, if you look at pounds of milk output for a dairy cow, if you look at yield per acre for corn, soybeans, most of the row crops, you look at, obviously it's a little slower turnover because variety improvement is harder in the permanent crops. But this, if you look at, pounds of almonds per gallon of water usage, this industry, with the possible exception of computing technology, has longer term, more sustainable productivity gains than any other industry. And I think most investors completely misunderstand that. They think of farmers as not necessarily that sophisticated, which is wrong. This is a science-driven industry with incredible productivity gains, on all levels. And if you look at, for example, the amount of acreage that a single human being can manage in row crop space today, you've probably seen that total acreage double in about 10 years. And that's this is just a repetitive process that's been going on ever since mechanization showed up in kind of World War II. And I think it justifies valuations that few people understand. Our business is very land focused, but the land itself is scarce, and the land mixed with the climate and water for the specialty crops is even more scarce. And I think that I'm super supportive of high valuations clear across the sector, and I think most investors kind of miss that.
Well said, Paul. Thank you all for the comments there. Appreciate it. Recognizing there's no one size fits all, certainly. And so last polling question here, folks. True or false, I have a good understanding of the value of my business. We'll give folks a few moments here to answer this question. And then we're going to go to Q&A. We're going to go to the Q&A session to help answer a few questions that folks have. One question that has come in, any of the panelists, feel free to respond. Are any of you investing in the hemp or CBD space?
I'll take that. This is Paul. We have looked at it, but we have not invested in it. I think that hemp as a crop, the real future is to see that come back as a fiber crop, where it takes up 3 or 4% of U.S. acreage. That'll help all the other commodities that are grown on relatively scarce land. CBD oil is interesting, but won't, in our view, ever take up a lot of total acreage of production, and is an incredibly difficult crop to raise. We've seen a lot of failure on the part of people trying to raise that crop. and it's all kinds of different problems. Weed control to getting too hot, as they call it, in terms of too high of THC levels. So I think it'll be important, but it's not a home run in my view. It'll be the fiber side that just becomes a significant part of the commodity universe we grow.
Thank you, Paul. Matt or John, are either of your firms investing in the hemp or CBD category?
No interest.
No, we are not, and broadly for the reasons that Paul described. But just to add the additional note that it is a highly regulated space, and we tend to try to avoid such sectors.
Do we still have Curt on the line? I wanted to, as we go through a few different questions here, I wanted to tee up a couple for Curt.
Okay, I'm here. Show my mug. Yeah.
Hey, Curt, what's the outlook on the walnut market?
The walnut market has continued, I think, in general terms, to struggle. The 2020 crop, I think, will probably have better movement again. Depends on our trade relations with China. And the problem with walnuts is there's a lot of older varieties out there that just simply don't have the production, or they don't have, the suitability from a consumer perspective. And the other problem with walnuts is that it's a very seasonal crop, right? And we're in the season where people buy walnuts. And the utility for walnuts, perhaps walnut oil and other things, is very limited. I am not bullish on walnuts. I think if you look across the landscape and across the Western landscape, you don't see a lot of people pulling almonds to put in walnuts. You don't see a lot of people pulling even lower quality vineyards to put in walnuts. It's just what I would consider a very mature. It doesn't have a lot of upside in my mind.
Thank you, Curt. John, anything you'd add to that?
No, I think that's right. And it's a big crop this year. I think Curt's right. I mean, China for both walnuts and for pecans was just a huge outlet for demand for the growers, and that's I've gone away for a little bit, but there's a lot of acres of walnuts going in China right now.
Right.
There is now 50% of the crop is Chandler's now, up from maybe 25% years ago. So I think we've flipped to 50% is kind of the name brand improved variety. But some of those older varieties, you're right, they're not great yielders. You got to tear them out and put in a new crop. There's a lot of investment farmers have to make. That with big crop and low pricing makes for a tough sector.
Hey, thank you both. Another question that came in here. All of you work with a number of companies. How have the companies that you've invested in or evaluated adapting to the pandemic and lessening its impacts? A lot of essential workers out there, from a PPE perspective, from a spacing perspective, at packing houses or process. How have these companies done overall from your perspective in helping lessen the impact?
If I could just make a quick comment on that, and I think actually Paul Pittman made a good point. When you go to California and you're in San Francisco, the way things are dealt with regard to COVID-19 versus Central Valley. So I sit on a sun-kissed board, and you go to those packing houses, and invariably those packing houses have kind of had one-off issues. One of the things you'll note that many of those packing facilities are open air. And so open air facilities have had a lot less problems than confined facilities. So if you look at a beef packing plant in the Midwest, that's a totally different situation, right? But if you look at a lot of the open air packing houses, particularly on the citrus side, they've had their problems, but it hasn't been an overwhelming problem. And in these rural communities, you just also don't have the COVID-19 impact that you might have if you had a facility, in a large urban area. So my only perspective on this as a lender is we do ask those questions, but also from sitting on a couple of boards, it's fascinating to see how it has transpired in rural America. But again, it depends on, and maybe this comes down to the final word from my view of this, is kind of depends on the style of packing house you have.
I think that's well said. Go ahead.
Yeah, sure. I guess the point I'd add is it, as you sort of led into it, being sort of on the forefront of PPE and worker safety. I mean, obviously, you just have to do it. But part of the issue is you can't control what the worker does when they leave at the end of the day. And if you have a big H-2A component of your labor force, which we do in some cases, it's just a very different, frustrating thing that you can't sort of be there overseeing your workers and keeping them safe. You can educate them and train them, but the real big question for our workers is how much, and we'll never know this for sure, the people and the tragedies that have happened, how much have happened because of what happens in the plant versus outside the plant. And I would venture that that most infections probably occur outside the plant if you're doing your food safety the right way. So it's hard to know for sure, but that's the frustrating thing.
All very good comments, John and Curt. Appreciate it. Brian Powell, I believe, has a question. Do you want to chime in here, Brian?
Yeah, Curt. I kind of promised Curt that I would ask this question, and to get in one of the questions that came in from the audience too is what is the view on long-term interest rates and actually current-term interest rates. And I know John weighed in a little bit on that, but since Curt is our resident lender here, what's your view?
Hey, I was saying rates were going to go up in 2013, so I'm not a resident expert. What I would say is that given the current economic environment, I don't see rates climbing anytime soon. Now is the best time to venture into refinancing or acquisitions. The rates are honestly, across the yield curve, the rates are really, really good, short-term, long-term rates. If I were looking to refinance or make an acquisition, rates that you see today are probably as good as they're going to get, although I would say this, I don't see long-term rates or short-term rates moving much in 2021. I think there's not going to be any major reset in that area. And I think, obviously, the administration can ensure that rates continue to stay low as a means of continuing to stimulate the economy.
Thank you, Curt and Brian. Brian, I'm going to turn it over to you, but first I just want to say really thank you to the panelists, all three of you, and Curt, of course, for your time today, your sharing of your experiences. I hope the audience learned a lot. I did, and really thank you all for the time. And Brian, I'll turn it over to you to out here.
Yeah, and I will echo those same comments to the panel too, Paul, Matthew, and John, and Curt. We really appreciate you stepping up and doing this presentations with us today, and including in this strange environment that we have going on here. So much appreciated. And if anybody wants the PDF of today's PowerPoint presentation, just reach out to us. And I think Amy told us about, how to get our CPE credit, so that's great. And then there will also be a on-demand recording of the webcast too, if anybody wants to take a look at it or share it. So I think with that, there will actually be a short survey that's going to come out too that we would like feedback on to make our presentations even better in the future. So with that, I think we'll adjourn the meeting and appreciate everybody's time and attention to this. Thank you very much.
Thank you all.
Thanks, everyone.